I'm Peter White. Welcome to the Inside Network. Welcome to the Inside Network's INDepth. My guest today is Simon Wood and Toby Bucks from Ausbil Investment Management.
Thanks, Peter.
Welcome, gentlemen. First up, can you define global small caps and tell me why the unrecognised potential of them is so attractive to you?
Yeah, thanks, Peter. So, global small caps is a great opportunity set. It's a great asset class. It's delivered about double the return that global large and global mid caps have over the last 20 years. There's about 4,300 companies within the universe. So,
what's the valuation marker to be a global small cap?
So the valuation, we generally look between $500 million US dollars and $5 billion US dollars. And I think there's two key reasons why it's such a great asset class, why there's so much unrecognised growth within global small caps. And that's firstly, it's a much lower researched area of the market, so it's much less inefficient than global large caps. So it's much easier to find those emerging global titans. And secondly, there's a lot of niche leaders within their industries that can expand through delivering similar product sets or expanding geographically. But also there is risk within the asset class, and I think it's really important to have specialist knowledge so you can dig into what companies are doing, what management teams are doing, how they're executing on their corporate roadmap, how they're going to deliver unrecognised earnings while navigating the risks that are endemic of fast-growing companies.
Can you talk us through the process for looking for those or finding those investable opportunities? You start with a clean sheet of paper. How do you find these companies?
Yeah, so as mentioned, we always focus on unrecognised growth. And what I mean by that is quality management teams with good consideration of ESG impacts, who can grow their businesses through a sensible and structured corporate roadmap, and companies which trade on attractive valuations, who are generating a lot of cash. We screen down the large investment universe to about 300 companies, which we think are the very best within the asset class. And then we do the heavy lifting. We speak to management, we discuss their corporate roadmaps, we talk about their culture, their ESG, and how they're going to deliver unrecognised earnings growth while also navigating the risks that they see within their industry.
Well, what about themes? How do you identify themes that are relevant to this sector?
Well, for us, we don't really start off with a theme. For us, again, it goes back to quality management teams with good ESG considerations. But there are many themes that provide tailwinds for our company.
Well, in a post-COVID environment, what themes appeal to you at the moment?
Absolutely.
Well, or are you on the lookout for anyhow?
Well, we've seen a real structural acceleration. These themes were already present in the market, but COVID has just accelerated some of those. You think about e-commerce and how that's shot up, how quickly that's expanded during COVID. Streaming, video conferencing, working from home, they're all themes that have been accelerated by the COVID dynamic. For instance, if you think about e-commerce and the US, we own a trucking company which has performed very well since the bottom of the market because it has benefited from the larger increase in goods and freight moving around the US. Likewise, we've also seen a preference for domestic vacations. Obviously, no one can get on a flight and not many people are staying in hotels. So the recreational vehicle market, RVs, has seen strong growth, and we've got a couple of key suppliers, both into recreational vehicles and sort of the marine
Well,
world.
they'd be both COVID-influenced themes that weren't there before. Would they'd be new themes?
Correct. That domestic travel rather than going overseas has really benefited because of COVID.
Are there any other less obvious ones that you've got your eye on?
We see that the streaming market, so the expansion of Stan and Disney Plus, there's some winners as a result of that. We'll go into the trade desk a little bit later, but obviously the advertising dollars that are moving towards those streaming platforms and connected TV is going to be very beneficial for the trade desk, which provides the marketplace for digital advertising, selling and buying.
Well, let's talk about Trade Desk. It's a big holding of yours. I think it's not a familiar name to quite a few people. Can you tell me what it does and how, and your thesis behind your enthusiasm for Trade Desk?
Yeah, well, Trade Desk is a great company. We identified it about 2 years ago, didn't we, Toby? I might let Toby talk about Trade Desk a little bit.
Yeah, sure. Digital programmatic advertising is growing at a very rapid rate as it's more efficient for people to advertise, knowing their return on capital for their investment and being able to access more eyeballs, and obviously more and more media is being consumed digitally. When we first looked at the Trade Desk, we weren't looking at that side of things. Our original thesis when looking at it is it just provided a much better outcome for clients and customers than anybody else in the industry. And so that naturally drew our attention to it. What we saw was a business that was focused on what was right and proper for the industry, what was right and ethical, and what would take the industry forward and where the industry should be. And that focus on ESG by management, when they set up their business model, enabled the Trade Desk in the future to capture market share and get an improved industry position. And particularly their focus on anonymous identification, and they built their business model around anonymous identification rather than Google and Facebook, who know exactly who you are. And that's really benefited them recently. So that focus on ESG at the start, what was right for the industry and what was right for the people involved in the digital advertising, gave them a better industry position because more people wanted to join the journey with them, whether it was customers, suppliers or employees. And so we've seen the Trade Desk get a lot of deliver a lot of unrecognized growth, better earnings delivery than people were expecting, because it's improving its industry position. And it's improved its industry position because of the way it focused on what was right and ethical for the industry at the outset. And going forward, we still think that because of that, they can grab a bigger share of the global digital advertising pie going forward. So, we've held it for 2.5 years. It's been a fantastic performer, but going forward, we think it can go up a lot, and there's still a lot of unrecognized growth there.
Do you think it is flying under a lot of people's radar?
I think now it's starting to become on people's radar. It's we always said it'd be a $500 stock when we bought it. It went through that, got up to 20 billion market cap. I think when we bought it, it was about 3.5. Yeah. So a lot more people are aware of it now, and it's now about to leave our index, which will mean that we won't hold it anymore and we'll search for the next Trade Desk. And I think that's one of the great things about small caps, is that you're operating in an opportunity set where people aren't looking at these stocks. I think they had 4 or 5 analysts when we first looked at it, and now it's got about 20, but it's still not covered by the major bulge bracket banks, so it's still slightly unknown. But it's the key thing about the asset class, that having that lack of attention just means, as Simon said, it's a much less efficient place, a much less efficient market, and it's easier to beat the market and find unrecognized growth. So people are starting to become aware of it now. When Goldman Sachs takes up coverage, well, that'll probably be time to sell.
Well, speaking of that, is there a point of melancholy when you have to let a stock like that go, that you have discovered, you like, you've followed, you've held, you've made money, and now it's got to go?
No, Simon and I...
No emotion?
No, we're happy to shoot anything once the time's right. We're looking for how much unrecognized growth is there left in the business. And when the market can see the growth that we can see and it's recognized in the price, we'll exit the position. I mean, it's not just we're letting go of something, we've got something coming through. So all the time we're working on a buy list to find the next Trade Desk, the next CSL, the next Google. So we've got some great companies that are under $1 billion that we own, and some that we're about to buy into that we think can have the same profile going forward. So it's more of a happy foster parent, thank you and good luck in the mid-cap world, while we go and focus on the next small little bright spark.
That unrecognized growth term, how difficult is it to recognise that unrecognised growth?
Yeah, look, it's really hard. Simon said you need a really specialist approach. We believe that good management teams that compound value creating events together will deliver more than people expect. And I guess that's one of the keys of how we do things. We're really looking, Simon's described it really well, but we're looking at using the capital structure, the balance sheet well to create value, looking at improving cost structures, new products or new geographies, and improving their premium pricing and improving their management team. And when you compound those things together, the sum is usually greater than the value of the parts, and that's how you get earnings revisions. We've consistently delivered earnings revisions on the basis of how we look at investments and what we're looking for. It's hard, but if you train yourself to look for the same things and you have a process that always narrows in on the same things, you stand a very good chance of doing it. At the same time, Simon said these are niche leaders that we invest in, emerging global titans, ones that own their niche and they've got opportunities to expand. We're not playing in players that are in commodity products or commodity type services where there's pricing pressure. So when you get that side of the equation, it gives you a real boost to find unrecognized growth. And then on the other side, small caps just under researched. You've just got far less people looking at them, and the people don't have the imagination on some of the companies to work out what they can do.
Well, you spoke about unrecognised regions or new geographies. Let's talk emerging markets for a minute. They've performed rather well in terms of COVID issues. What's your view? How do you approach them in terms of looking for small cap opportunities? Are you a bull, a bear, or neutral?
Well, it depends on the market. Latin America is a very different place to Southeast Asia. At the same time, we invest in companies that are listed on developed market exchanges, but a lot of companies that we own have strong exposure to emerging markets, whether it's Amplifon or some other players. Emerging markets tend to perform better with a weak dollar and an improving economic environment, and those are things that you're seeing at the moment. Global small caps tend to outperform even more when there's an improving economic environment, but they're not dependent on a weak dollar. So I think you're better placed to get a stronger return going forward out of global smalls, because we never really know where the dollar's going to go. It's a cruel beast, the dollar. The things that drive it change over time. I mean, at the moment, the lack of real return in euros is pulling the dollar in one direction, while the money printing going on is trying to pull it in another. So it's an interesting beast, the dollar.
Concentration risk, a term familiar to you both. I think 20% of the big indices are tech companies at the moment. How do you cope with that? And what does it take people's eyes off the other balls that you're looking to invest in?
Yeah, I think there's a huge amount of risk in the market. 25% of the S&P is in 4-5 companies. That's much higher than we saw in the .com, where it's about 18% of the S&P.
Is it sustainable?
Well, nothing's ever sustainable forever. I think the factors that are driving that concentration in the market are currently in place. So we've seen lower bond yields for longer, drives the valuation of growth companies and blue chip companies, a weakening manufacturing environment from sort of beginning of 2018 to now, again, has driven people towards those growth and disruptive companies. The level of valuations are extremely stretched, and we saw that about a couple of weeks ago when the market corrected or started in a correction, particularly on the Nasdaq, where the stocks were hurt the most. Does it distract people's eyes? Definitely. We're seeing a plethora of investors into the market pump money into Tesla and Facebook and Apple and Google, and not look at the people that are benefiting more. So, for example, on Google, you can buy other companies that are benefiting. We mentioned the trade desk. When you look at Apple, you can look at the suppliers to Apple that are trading on much cheaper valuations with much higher growth going forward and opportunities to expand into new products. We own a couple of those. So I think people's eyes are always away from small caps, and at the moment even more so. If we see the US yields steepen further and inflation expectations come back into investors' mindset, that'll drive the rotation away from the FANG plus type stocks towards businesses that have got the growth backed up by the cash flow. And I think you'll see a normalization of valuation levels across the index.
But at the moment, that concentration that we're talking about, in fact, is an opportunistic situation for you.
Yeah, we think so. We've seen over the last 2.5 years, since we started the fund in May 2018, traditional metrics of valuation have gone out the window. People just want to buy growth at any price. And it's a very similar environment to what we saw in the .com. And that will come back. What drives it? We think it's the yield curve steepening and inflation expectations coming through, but it will come back. And it will really benefit small caps. It'll benefit businesses and investment processes that focus on the valuations, where they're putting money to work. And you'll see people become more sanguine about the unloved parts of the economy as we see a rising tide lift all boats, and we may see some money flow away from that area and into areas where growth is returning.
Well, can we talk about or identify, say, 3 of the fastest growing companies that are on your radar that you're either hold or about to hold that you're excited by?
Yeah, so these are 3 companies that we hold in the fund. Obviously, it's not professional investment advice for people to go and buy those stocks, but the trade desk we've mentioned, that'll be one of the fastest growing. Generac, which I'll talk about, is another one, and SolarEdge, maybe hand over to Simon to talk about. Generac's delivering almost 50% EPS growth this year as an industrial. It's a business that we've held since 2018 that makes generators. But we talk about niche leaders that are expanding geographically and in new products and improving management team and improving pricing. We get that with Generac, which is a business that
what's its USP? Why is it different or better?
Yeah, well, it makes the best generators you can get for residential and commercial industrial. And it makes them in all different formats depending on whether you're a hospital or whether you're a small residential unit. It's gone and bought an Italian company that gives it great access to the emerging markets. So we've seen it growing into new markets geographically. At the same time, it's now expanding into wall batteries and solar inverters, which are gaining in popularity because of blackouts, but also because of the changes we're seeing in government subsidies. So it's expanding geographically, expanding in new products, improving its management team. It's getting more efficient in the way it produces these products, so its cost is driving value. And at the same time, we're seeing the market become more understanding of where its future growth roadmap goes to. So that's a business almost delivering 50% EPS growth this year in an environment where the market's going to deliver somewhere between -30% and -20% on the fiscal year.
What exchange is it listed on?
That's on the New York Stock Exchange.
And you mentioned a final company as well. I think Simon's going to...
Yeah, so SolarEdge. SolarEdge we'd been looking at for a while, late last year and earlier this year, and we were waiting for an opportunity to buy it. We got that opportunity during COVID when the stock price went down significantly. So SolarEdge makes solar panel optimizers and inverters, and what solar panel optimizers do is they balance the load between the solar panels and make them much more efficient, and solar panel inverters take that direct current that's produced by the solar panels and switch it to an alternating current that can be used, sold back to the grid. For instance, it can be used in wall batteries to power your Tesla. SolarEdge was started about 15 years ago by 5 friends who are engineers. They've continually been able to develop new and excellent products. They just better quality, great valuations. They've got the tech supporting it, so they've got the app so you can control your solar panel infrastructure. And we see, just with the theme and the growth of renewable energy across the world, I think SolarEdge is really going to be able to just continue supplying its high quality product set to its customers around the world.
Is SolarEdge active in Australia?
It is. Yep, a friend of mine actually just got their optimizers and inverters, or has just ordered some. So yeah, they do provide their products down here.
And if I got solar panels for my house, would I automatically come with SolarEdge, or is it an additional?
So you'd talk to your solar panel provider,
yes,
and they would discuss with you the optimizers and inverters and how you wanted to manage that. And don't forget, you can obviously sell some of that back to the grid.
So it's a value add. It's not the vanilla option, but it's the value add option, is it?
It's the value add. You do need an inverter and an optimizer, and because of SolarEdge
has an edge in that.
It does.
Business.
It has an edge there. So they're definitely the people to talk to if you are thinking about putting solar panels on your roof, for instance.
We mentioned ESG a little while ago. What's your approach to ESG in this global small cap area? How important is it? And maybe you can speak to that issue in terms of how important it is when in making decisions for investment.
So for us, it's absolutely key. It's key for returns, and as a result of that, it's a core part of our process, both at the wider Ausbil house, where we try and see ourselves as leadership in the ESG space, but also in the fund. We do a lot of work on ESG. It's one of the first things we do when we ever look at a company. And the reasons why are, one, it reduces risks. it highlights good management teams, and it gives you an indication of the management team's ability to know about what's going on in their business. More importantly than that though, having a good focus on ESG and doing what's right and ethical for your business and your industry will improve your industry position, because employees, customers, people will want to come along for the ride and take part in that journey. And hopefully we've explained it when we talked about TTD. It was their focus on ESG that enabled them to get in a better position for clients than Google or Facebook was offering. And that's how we think about it. When you have a strong focus on ESG, you get an improving industry position. As you improve your industry position, you're going to take a bigger piece of the pie and get better returns. So it's not just a negative filter for us. We're not doing it purely for an ethical sense. We're not doing it purely to reduce risks or
performance enhancer.
It's about getting the best returns from unit holders. And then we've got a number of stocks that are benefiting. So the trade desk has benefited from the way it's set up, and Generac and SolarEdge have benefited from their ESG focus they have within the company, but also the increasing focus on the environment by their consumers and all the drivers you see there.
Some logic or some observers would say that with cheap money, virtually no interest rates, big companies are more likely to be able to make an opportunity into a payday in this climate rather than small companies. How do you counteract that argument when you encounter it in your sales pitches?
Look, larger companies, particularly recently, have taken on a lot of debt to buy back shares and increase their return on equity. But they haven't driven underlying business improvement. Larger businesses generally have less ability to execute on growth initiatives than smaller companies. We really focus on free cash flow. It's something for us that's really important, because we want to make sure that the companies that we're investing in can not only have a strong focus on cash, but also can return cash to the providers of capital, but also they're not limited on any of the growth initiatives they see in front of them. They can capitalize on any opportunities that they have. The businesses we invest in have strong cash flow, but also at the moment, the market and banks are very willing to give money to quality businesses, and that's what we focus on, quality businesses. So there's absolutely no limit to the capital that these guys can get their hands on if they need to grow at the moment. And also, as we move forward, what we've seen is large caps have seen a re-rating because of lower interest rates and way the environment is, and they've bought back shares to improve their return on equity, and you've seen their share price go up. They haven't been driven by improving corporate earnings. We really focus on unrecognized growth and improving corporate earnings, and going forward we think delivering earnings beats is going to be a much bigger driver of returns over the near term.
So you're saying the innovation really is still in the smaller companies, and the big companies have just been using the current climate or financial climate to actually reform their capital structures rather than reform or improve their operational side of the business.
For sure. I mean, you look at Facebook.
Is that widely recognised, you think?
I don't think so. But when you look at Facebook and Google, those were brands banking new business models in the noughties. Right now, they're getting disrupted by the trade desk and by other players. Everyone gets disrupted. And when you own niche leaders that have a technological leadership and a product or service leadership, they're much better positioned to take advantage and disrupt the incumbents than the large caps are.
Do you think that cycle of disruption is shortening? It's happening quicker?
Yeah, for sure.
We can all remember when Microsoft was the biggest company in the world, but that's a distant memory, isn't it?
Yeah.
And the cycle is getting shorter.
It changes so often, and you mentioned edge computing and AI, but a lot of the companies that we see, what they're able to do for clients is far superior to what the incumbent can do. And so, I think that cycle's shortening, which means, as you suggested, that small caps are a better place to be.
If you can allow me an observation, it does seem to me that your job is more fun than the average analyst looking for the exciting companies and the change and the innovation.
Yeah, for sure. We love it. I mean,
100%.
If we have to analyse Google or Facebook with 60 analysts covering the stock to try and work out the minutiae of an EPS beat, there's nothing fun or interesting in that. But finding the trade desk and working out how it's going to take Alphabet and Facebook's money is much more interesting. When we find Generac, SolarEdge, and we've got some much smaller companies that are a smaller position in the fund because they're less liquid, we've got some really interesting business models that are taking their industry by storm and getting a lot of returns. So we love it. It's the most interesting job in the world.
Well, this whole privacy issue with big data and everything, there must be opportunities coming through there.
That there are. So, there's a number of opportunities. We see the trade desk as the biggest opportunity because they solved that anonymous identification piece of the pie early on, and the pie's so big and growing so quickly, they stand to really benefit. But no one really wants to have their personal details bandied around. And also when companies maybe use that a little bit more than they should, or customers have agreed to, you get issues for the companies. So GDPR in Europe, new legislation around what information you can take off people, really affected the industry, and Trade Desk benefited from that. But you're going to see more and more policies that give the public what they need in terms of what the social norm should be, and the social norm should be fair and equitable for everyone.
Well, it's nice to finish on a positive note. Simon, Toby, thanks for talking to us today.
Thanks a lot.
Thank you, Peter.
Thanks for your time.